Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P and the QQQs hitting brand new all-time highs. Just another day in the most hated V-shaped rally possibly of all time at this point. Now, a lot of the reasons behind the gains in the SPY, the QQQ, and the entire markets overall is because we had a CPI report this morning that came in largely in line with expectations, which furthered the probability for a September rate cut by the Federal Reserve. The probabilities of a rate cut in September at this stage stand at 93.4%, which is the market consensus. And overall, that is a slight improvement from just one day ago when it stood at about 86%. And of course, the market took that in stride. So in today's video, we're going to cover a few things together. Number one, we definitely have to go over the details of the CPI report. What happened? What were the numbers? What are still some of the categories experiencing a little bit of residual inflation? And what are the impacts of tariffs on the inflation numbers so far? We'll do that in the first part of the video. Thereafter, we will take a look at two company earnings that had earnings today. Number one that we're going to be going over is going to be Circle, a very popular name in today's trading action. And number two that we're going to be taking a look at is going to be CoreWeave. So we'll cover those two corporate earnings. Thereafter, we are going to get into our major technical analysis on our major stock market indexes, followed by our big tech name list as well, and derive, amidst all of the bullish action, are there still some opportunities that are ripe for our investments or maybe even swing trades? And to wrap it all off, I'll take a quick little glance here with you guys at our biggest gainers and losers of the day. Losers of the day, there weren't so many, but some are possibly due for some swing trades. And then to the upside, we had a lot of names pushing. Are these names still buys or have they ran a little bit too much? We will conclude today's video with the ever so popular biggest gainers and losers of the day section. So without further ado, guys, let us jump right into the action, shall we? So the S&P up 1.06% today, the QQQ's up 1.26%, and you can see very nice broad day of performance. Take a look at all sectors firing on all cylinders today. A lot of green in the markets today. Amazon being a little bit left behind, but that's okay. Company is still staying on very strong fundamentals right now. Microsoft, Apple pushing up 1%, some decent gains across semiconductors. A nice broadening out of semiconductors. You guys must remember yesterday when I referenced the 1 month performance of a lot of the names in this segment right here being somewhat lackluster. Today, the entire sector playing a little bit of catch up, even software catching a little bit of a bid. But on the 1 month relative, this still remains one of the weaker sectors in the market, but you can possibly find some decent opportunities if you know where to look. Moving on further, financials, decent day. Healthcare was fairly mixed, but in the green, and the bottom half of the market responding well to the possibility of the ever elusive September rate cut headlines, right? So that being said, the market was pretty decent today. Broad market performance. Nice to see that. In terms of your 1 day relative, you can see that even better. Everything up and to the right, and several sectors up multiple percentage points. Very strong day. And on the 1 week relative, well, we've erased some of the negative performance of last week, but not all sectors are still in the green. Only real estate, energy, and healthcare being a little bit left behind. The market, though, led heavily to the upside by communication services, which was a good portion of Meta and Google, especially in the past week, right? And then after consumer cyclicals, which have been coming back in a big way, and technology. Those are your three main performers of the last week of trading. Before we get into more technicals, though, let us dive into the CPI numbers. Why did the market react so well to them today, even though they came in roughly in line? So take a look at the headline print right here. Year over year was supposed to come in at 2.8. Came in at 2.7, but that was in line with the previous month. So it did come in lower than the consensus, but exactly the same as the past month. That's why I'm saying kind of in line with last month. We didn't really have a downtick in inflation, but it also did an uptick as well, which kind of was keeping the market a little bit nervous yesterday, right? Everybody was expecting an uptick, a lot of nervousness, a lot of unwinding of positions yesterday, very low volume day and a red day overall. But today, people piled back into the trade because now the utmost certainty of a Federal Reserve cut is probably just around the corner in the month of September, right? Now, moving into core actually uptick here, 3.1% versus the 3% expected. First time in like 6 months that core has printed over 3%. Now, some people are a little bit nervous about that, but then again, this one does strip out the volatile food and energy segments of the market, both of which have actually been contributing to keep inflation a little bit low. Oil prices have been low, and food, surprisingly, has not been seeing that much inflation overall. If we want to break this one down by category, here is your all items, so you can see exactly the same print as the month of June. If you take a look at food at home actually coming down from the June read, 2.4 down to 2.2, which was not so bad. Energy, very decent, still in deflationary territory, minus 1.6% on a year-over-year basis. Apparel had a bit of an upswing here, May, June, and July, still in deflationary territory when measuring across the last 1 year's worth of data. However, seeing a slight uptick, although still being in deflationary territory. And we're going to get into that because a bit of this is due to the tariff impact overall. Shelter, which has been one of the stickiest components of inflation, still in the midst of a downtrend right now, still well above your core and well above the headline number, but moving in the right direction overall. That's exactly what we want to see. And the overall services industry too. This one additionally was remaining a little bit stickier, especially stickier than goods, right? But now down about 3.6%. That has been the same for a better part of the last 3 months. So that is why your overall inflation rate is not necessarily moving down. We had some other headline numbers such as airfares were up 4.4% month over month, or rather year over year, excuse me. But on the month, they were higher. But overall, guys, not that bad. And we take a look at all the food category. You can see that all food right now still sitting at about 2.9. It was a slight downtick from the month of June. So overall, though, guys, not a very bad inflation port at all. I'll remind you, if you don't believe in the CPI numbers, well, maybe you can believe in the trueflation numbers, which do show a similar pattern here that for the month of July, inflation was really at about 2%. I like trueflation because it measures 30 million different items, and those items are repriced daily to form this index. You can see where we're sitting right now in the middle of the month of August is about 1.83, so nowhere close to 2.5. I would prefer to use this metric right here because it shows more items in real time overall, but at least the headline CPI was not as bad as people were anticipating, right? In terms of the tariffs and the tariff impact on inflation, well, you can see here, guys, that U.S. tariff revenue has reached a record $27.7 billion in the month of July. A lot better than we've seen, of course, over the past 5 years. It's now been several months where we've been having net upticks in tariffs, currently hitting a record of about $27.5 billion. However, that does leave an impact on some categories. Here we have a hunting for tariff inflation graphic. But what I want to show you is that everything is kind of mixed, right? So the line is basically the Liberation Day line right here. So we want to gauge the impact of what's been happening since the Trump tariffs. Appliances initially saw a bit of an uptick and now actually down month over month. Clothing, roughly flat since prior to the tariff. So a lot of people thought that clothing might be seeing huge upswings. We're not seeing that yet in the markets. Coffee up a little bit, but nothing major, 2.3% month over month. Footwear is one that actually has seen a lot of inflation because a lot of the footwear is manufactured in Vietnam and China, and those two nations had some pretty heavy tariffs in terms of where we stand now at an effective rate. You can see the 1 month change here, 1.4%. But then again, how many shoes does the average household really buy? Furniture, another interesting one, a big purchase for a lot of people. Furniture is actually down 0.9%. So this is actually deflationary, surprisingly. Sporting goods having a slight little downtick here from the month of June all the way through the July print. Tools, this has been one that's upticking here, 1.6%. And toys, initially seeing an uptick in the early stages of those tariffs, but now normalizing a little bit, only 0.2. So as you can see, the impacts of the tariffs on many different categories still somewhat unclear. I wouldn't say we have enough data in terms of, 3, 4, 5 months of being at the true effective tariff rates that came into place in terms of August the 1st. But you can see that the impacts of tariffs so far have been quite muted. But we'll keep an eye on that and see what develops, of course, over the next few months. But overall, a very decent print. And I'll remind you, the takeaway from this print is the fact that right now the Federal Reserve has an analysis to do in terms of the balance of risks. And most people do believe that the balance of risks now lies more heavily towards the labor market. As a result, since we are not seeing any meaningful upswings in inflation, well, the Federal Reserve can possibly start to try and preserve the jobs market. That is the nature of the dual mandate, protecting full employment, but also controlling inflation. Now that inflation is not rising in a very rapid fashion, maybe because of the jobs data that we got about 2 weeks ago at this point, maybe the Federal Reserve can start cutting slowly, but start cutting nevertheless. And that is why the market was so happy today after the inflation print, despite it is a high number objectively in relation to their 2% target. At least we're not talking anymore about runaway inflation. So that's everything I had for you guys for the CPI, essentially the data, right? So hopefully you guys enjoyed the little recap that I did for you right there. Now let's move into the details of our two earnings. And we're going to start it off with a very fun company, one that's had a lot of retail interest recently, hit a high all the way earlier in the month of June, and then kind of has been down ever since, down almost 50%. And you can see here, Circle reported earnings today. Initially, when they reported very early this morning, the company was up like 14%. They gave it all back throughout the day, and then they pulled the SOFI. In the after hours right now, it's down 6.11%. Why? Well, unfortunately, they did a 10 million share offering plus 1.5 million extra shares that underwriters will be able to buy over the next 30 days. So a little bit of a dilution news headline, which did hinder the stock price. In relation to the current float, that is about 5% new shares on the market, which is why the share price has now adjusted by about that 5%. It's down 6, obviously a little bit more sentiment there. Usually when you have a dilution event, the market will correct pretty much for the exact amount of the dilution. In this case, it's 5% of the float. You can see the stock is down 6% in the after hours, but they still gave it all back. So right now, at $150 in the after hours, is Circle a buy? Well, this one is a bit of a complex subject because it's not the same business model as you truly see in other traditional companies. Let's move into some of the headlines, though. Circle shares rise as second quarter revenue jumps 53% on strong stablecoin growth. Let's move into it. The validation that we've seen in Circle and the sentiment around Circle is really about people understanding that the internet is colliding with the financial system. Just like open internet, software, networks, and utilities changed media, communications, services, and retail and education, it's happening in the financial system, and stablecoin money and blockchains are foundational to that future. Now, a little bit of context in terms of stablecoins, right, guys? Stablecoins, the premise of this trade is not necessarily that you and I can exchange money faster or for less fees. No. It's the back end of the financial system. Right now, most interbank payments, most currency swaps go through the SWIFT banking system. And the amount of fees associated with that system are very high from bank to bank. And also the transactions are not so instantaneous and have to be ledgered in a somewhat antiquated way. Now, blockchain and the stablecoin the nature of stablecoins changes all that for the future. The transactions are faster, they're cheaper, and they're also more transparent, which is why you see a lot of banks pivoting their systems towards favoring some of these stable coins. So truly, it is more of an institutional play than necessarily benefits for the end consumer, people like you and I. Let's move into it, though. Circulation of USDC, the stable coin that Circle issues and manages, grew 90% from the previous year, now up to 61.3 billion in terms of value in circulation right now. However, in terms of the profitability of the company, Circle said it swung to a net loss of 482 million. And those charges related to IPO charges of 424 million and 167 million for the adjustment to fair value of the convertible debt. So unfortunately, Circle not able to turn a profit this quarter. A lot of fees associated with the initial debt that it raised. Also a lot of fees associated with the IPO and stock-based compensation as a result of that IPO. Now, here's what Circle had to say in terms of the forward guidance. It anticipates that the amount of USDC in circulation will grow at a 40% compound annual growth rate throughout the cycle. This is important, guys, because of the business model of Circle, right? They make money on fees and total transaction volume overall. So we can derive some revenue growth metrics from how much stablecoins Circle is able to grow, well, how much the network is able to grow in the future as well. If they're saying that we are able to grow at 40% compound annual growth rate through the cycle, which they assume to be for the next 2-3 years, we can start to extrapolate what potential revenue growth rates and what bottom line income rates could be from that. We're going to get into that in just a few short moments. Circle also announced the forthcoming launch of a new proprietary blockchain called ARC, designed to be a network for stablecoin payments, foreign exchange, and capital markets applications. It will be integrated across Circle's platform and services and will begin testing among developers in the fall. What I read when I read this new proprietary blockchain called ARC, I read more dollar signs for the company, more bottom line profits, a brand new network for them to operate and manage. Now, Circle is the second largest stablecoin in the world, making up about 26% of the dollar-backed stablecoin market, behind the market leader, which is Tether USDT, which makes about 67% of the whole market. Here's what the CEO had to say further. Since our IPO and since the Genius Act passed, the number of major financial institutions that are engaging with us in banking, payments, capital markets, and so many categories has surged. We're seeing this incredible interest in working with us. So very beautiful comments by the CEO, but in terms of the price of the company, right? How do we value this thing? Because it's a bit of a more complex model, not traditional to your, traditional sales from an actual product or things like that. Let me take you through a few of the highlights, and then we're going to get into how we can possibly put a valuation on this and whether or not it's an actual buy. But you need to understand what the business is trying to do first. Key highlights here, momentum and growth. As you can see, the net worth growth, 40% year to date, but 90% year over year, which is insane. 5.9 trillion in on-chain transaction volume. That is 5.4x year over year. That is massive. Lots of very large key partnerships. Binance, Corpay, FIS, and Fiserv, which is very good. This is Fidelity, essentially, FIS, and OKX platform too. Then moving on further, you can see the stable coins in circulation. A ton. This is the overall market. What is the total addressable market? Look at the amount of stable coins in circulation, guys. These are not going away. This will be front and center to the financial narrative here, at least in the next 2 to 5 years, in my humble opinion. 50% year over year expansion of the total addressable market, and stablecoin transaction volumes, 75% year over year. Fantastic. And stablecoins only represent right now 1% of the total M2 money supply. There is your total addressable market. It is absolutely massive for this company, so you really need to be paying attention to this stuff, guys. Stablecoins in circulations as of Q2, you can see Tether with the dominant landscape of market share here. USDC a little bit lower. Everybody else has next to nothing, but USDC is the only publicly traded company at this time. So if you do want to have a position in one of these stablecoin leaders, USDC, or rather Circle in terms of the stock, kind of is the only opportunity that you may have. Now, the CEO talked about the benefits of the Genius Act, right? Now, what is this essentially? Well, it is more clarity and more regulation for the blockchain overall. You have supervision, of course. You have strict reserve requirements, which need to be backed by either cash or treasuries, which is very solid. A lot of people didn't want to use crypto in the past because the balance sheets were sometimes a little bit sketchy. People weren't sure if they were maintaining the proper reserves. And now with the Genius Act, you can actually have a lot more transparency into the networks overall, which has essentially benefited this company because now all the banks want to use their networks overall. Now, moving into what they're doing in the future, they're also going to be doing a euro, which is going to be very interesting. As of now, only US dollar denominated stablecoins. They're moving into EURC, which is basically euro and the Circle version of that. A ton of supported blockchains overall, which is very good, of course. Now, in terms of the rest of the things that we actually care about, right here, you see more of some partners and how the landscape is really going to benefit from everything. All of the major payment corporations right here, payments and remittances, will be able to use the back end of Circle essentially for a more stable ledger and for faster transactions, and also less network fees in terms of foreign exchange. A lot of these companies pay a ton of exchanges to the banks in terms of foreign exchange. Paying less fees just means that the banks are going to be able to do more transactions. So the banks are going to get cut a little bit on their FX fees, but that's fine. Everybody wins in that scenario, guys. People want to do more business and more volume overall, which is, it's accretive to pretty much everybody in the landscape overall. So here we have some details on Binance, of course, that's fine. But what we want to take a look at here, guys, is this network, right? Their on-chain transaction volume, 5.4x year over year, very solid and meaningful wallets. This is very important, guys, right? 5.7 million meaningful wallets holding Circle right now. So it's growing. It's growing. The trust in the platform is growing as well. And what I want to bring your guys' attention to is this slide right here. Coinbase has 20% of USDC in circulation. Coinbase will make a lot of fees on that, remit some fees all the way to Circle. But suffice to say, in terms of the money that Circle itself is making, we got to cut that back by about 20% because Coinbase is making a decent chunk of change on fees associated with Circle within their platform. So it's not fully out to market and pure. Coinbase does have about 20% of that landscape overall. Now, here is what you have to focus on if you want to analyze this company, right? It's called the RLDC margin. This is revenues less distribution costs. So obviously, for people to use Circle, there's a lot of incentives that are paid out, and Circle does not realize all of the revenues on the total payment volume that goes across its network. It makes total revenues. This is the number right there. And then from these revenues, you have to subtract, well, what are the margins that they actually make on those, right? The margins are anywhere between 35 to 40% on the revenue figures that you will see. So here you can see, guys, right there that the total revenue and reserve income is up 53% year over year. As more stable coins, as more USDC hits the market, Circle makes more revenue from this. From this revenue, they have to make some payouts, and the amount of money that they keep at the end of the day is pretty much 35 to about 40% of all revenues collected. So that allows us to forecast profitability into the future overall. So you will have to forecast revenue expansion based on the company's guidance. If they're expanding USDC tokens for the cycle, 40% year over year, stands to argue that their revenue should fall in line, roughly growing between 35 and 40% per year as well. If you want to understand what amount of money the company is going to make in terms of operating margins, well, you would take this revenue and then do 35 to 40% of that, just helping you guys out a little bit there. They make a little bit of other revenue as well from advertising and other miscellaneous fees. But that is the business model overall. You can see that the EBITDA margins are not too bad right here, currently at about 50%. Operating expenses up year over year. Obviously, a lot of sales and marketing, not too much R&D in terms of what they have to do, but sales and marketing and general and admin takes a little bit of that overall. But 38% year over year in terms of the reserve income less distribution is not too bad, guys. Those are pretty good margins to base everything off of. So you can see here is their guidance, USDC in circulation, 40% compound annual growth rate, which is very good, with also a forward guidance of anywhere between, I said 35 to 40. It's roughly 36 to 38. You can assume that this is going to be some of their longer term margins as well, as they really don't have to change much in their business model as they scale higher and higher. So Circle right now, is it a good deal at $153 per share? Well, we can't really use price to earnings, guys, because their earnings are not really here. Take a look here. Earnings per share are nowhere to be seen, and we do not have any guidance further than 1 year out. Revenue as well, we don't really have any guidance, but what we do have is the expansion throughout the cycle of the overall network, about 40% year over year. We can use, I mean, if you guys want to do some better modeling, you can use, I mean, this is going to mean nothing to almost you guys, but those of you that are trying to build discounted models for this one, enterprise value to sales is not a bad one to use because the company doesn't really have much debt overall. But I digress. If I wanted to keep this very simple for the average viewer, you can use a metric which is called price to sales, okay? Roughly price to sales. And if I'm encompassing the overall sales expansion of the company, here's what it might look like. 2025 sales are currently going to be about $2.6 billion. I call it sales. You can call it revenue as you wish, right? The forward price to sales at 100, and I did 163 before the dilution event, is about a 14.28. That is not crazy. It's in line with most, whether you call it a tech company or a finance company is up to you, right? But a fast growing tech slash finance slash fintech company is not too egregious at 14.28. The industry long-term average, a lot of these businesses over time is about a 10. So I've done two cases here. You can always use it as a price to free cash flow as well, because the company does make a decent amount of free cash flow, but it's very low so far. The more adequate metric here is probably going to be forward price to sales and running just average projections for a bull case and a base case. If we take the base case at 10 price to sales by 2027 and just do streamlined expansion of their markets essentially and of their sales pipeline, just considering they'll make the same amount of money on every extra dollar that they make for the next 3 years. At the end of 2027, guys, you end up at a $55 billion market cap, roughly. If we use 10 price to sales with their forward 2027 sales numbers, that gives them a price per share of roughly $242, which is not bad, right? 242 divided by the current share price right now is roughly, let me just tell you that, right? Divided by 153, that's not too bad. It's about a 59%, that's about a 59% upswing in the share price, right? Not too bad for this year, 2026 and 2027. If you take 3 years, even though this year is almost pretty much done, right? It's about a 20 something percent compound annual growth rate, depending if you use 2.5 years or 3, up to you, right? If we take the bull case and the company is still allowed to trade at a 15 times price to sales multiple come 2027. This is your bull case. You're looking at $344 per share, roughly, which from here is, well, you guys know it's roughly over a double, right? 2.24x essentially, which is a pretty good compound annual growth rate, guys. That's like 40% compound annual growth rate, roughly. So there is some decent upside here on Circle. The company really doesn't have any debt. All they have to do is keep executing. They have a ton of very large clients, and the financial institution is redoing their entire back end to favor stable coins. I do think this one is a play. I'm not saying it's going to be an easy play. It is going to be very volatile. But here, 153 down to 120, even if we get there, guys, I think there is a lot of money to be made here. It's a riskier bet, of course. You have to extrapolate a lot of numbers right now from a business model that is kind of brand new to the market, but I think there is definitely some money to be made here. The margin of safety is quite large. Even if you use like an 8 price to sales, you're still getting a very decent compound annual growth rate, especially from here. So myself on Circle, I will be positioning in Circle. I will be buying some shares for the longer duration, for the longer term, and going for the expansion of the company's network, going for the expansion of the company's total revenues, and eventually when they do scale, they have decent enough margins to bring in decent free cash flow and decent operating margins and decent net margins as well, because, right, as we saw, their version of, well, I mean, you can call it operating margins or you can call it their custom margins right here, are quite good. They're quite good, and this number, it should not come down much over time. So I do enjoy those margins for this company. Now it's just a question of them scaling their offerings. So pretty decent buy, but like I said, it's going to be bumpy. So you pretty much have to kind of DCA and then just leave the shares ride for the next 2, 3, 4 years and let the company execute. That is everything I had for you guys for Circle. Hopefully it wasn't too complicated. I try to make it as simple as possible, guys. But you can obviously deep dive this a lot more. Like I said, if you want to deep dive in modeling and stuff like that, I'd probably use enterprise value to sales, which also represents some decent upside from here at 153. If it were all the way back up there, no. But here, yes, I do believe there is still some good compound annual growth rates to be had. Company number 2 that we're going to be covering today is going to be a little bit easier, but an IPO nevertheless. We're going to be talking about CoreWeave, the company that made its way all the way up to $186. Guys, from the lows of 38, right? How much was this? Almost 400%. And then in the past few months, the company was down 46% before ending right in the middle here. They had earnings after the bell today. You can see that on the right-hand side, they're down 10% after earnings. Let us dive into CoreWeave and see. A lot of people claim that this company has too much debt. They'll never make any money. They have too much debt. The business model is unsustainable. That's debatable. I'll show you one other company that you guys probably know very well, which also arguably has a quote-unquote unsustainable level of debt in relation to their market cap. And I'll let you guys decide at the end whether or not this is a good bet or not, but I will present the facts right now. Take a look at CoreWeave's earnings, miss on EPS by about 17%, but they did beat on revenue by 12.11%, and their guidance for the future in terms of money in the pipeline is absolutely massive. Let's have a look at the CoreWeave article, shall we? So CoreWeave shares drop even as revenue and guidance top estimates. Let's move into it, shall we? Revenue more than tripled from a year earlier. The company registered a $290 million net loss compared to a $323 million loss in the second quarter of 2024. So the loss getting a little bit smaller as the revenue exploded, right? More than triple. Now, moving on further, revenue growth continues to be capacity constrained with demand outstripping supply, which is always a very good problem to have. The company competes with cloud providers such as Amazon to rent out NVIDIA chips to companies. CoreWeave's operating margin shrank to 2% from 20% a year ago, due primarily to $145 million in stock-based compensation costs, very normal with IPOs and very early-stage companies such as Circle, well, at least in the public markets. Debt now sits at $11.1 billion. This is the number that is going to be the core focus of a lot of people out there, but I'll show you at the end of the video why it might actually not be so unsustainable. So in other words, it might just be sustainable. CoreWeave CEO Mike Intrator pointed to an expansion in business with OpenAI, a major client and investor, and he said that Goldman Sachs and Morgan Stanley are also becoming customers. For the third quarter, CoreWeave anticipates $1.26 billion to $1.3 billion in second quarter revenue. The analysts were estimating 1.25, so they beat on the revenue guidance, but they also raised the full year end guidance too. CoreWeave now sees 5.15 to 5.35 billion in revenue for all of 2025, suggesting a 174% growth rate. The analysts had targeted about 5.05, so raising the estimate by a fairly decent margin here, guys, by about 5% for the year end, which was good enough for the market. CoreWeave aims to start letting people rent out GPUs on a spot basis. That means that CoreWeave can quickly take back GPUs from customers if the company decides they're needed elsewhere, but costs are lower than they would be when bought on demand. So CoreWeave has a lot of very large clients, but they do have very concentrated clients. Microsoft, IBM, and OpenAI representing roughly 80 to 90% of CoreWeave's entire customer base right now. Very large clients to have, but very solid clients nevertheless. Those clients are probably not going to be going away. So here is your Q2 25 at a glance. You can see the revenue was up 207% year over year. Revenue backlog, look at this number, guys. $30.1 billion in revenue backlogs, which is the exact reason why they're able to scale their operations and why the debt market is allowing them to essentially take on more debt, right? Now, capital expenditures, $2.9 billion. We're going to talk about that. Adjusted EBITDA, 62% margin. That is very good, guys. If you can come in right now as you're scaling with very high EBITDA margins, it means that when your operations are fully scaled, you have a very good chance at turning, very good operating margins, but especially decent net margins as well. Free cash flow is going to be a while away because they have a lot of CapEx to get through, of course, but still not too bad. Operating income margins, 16%. Not terrible at all, considering the company's only been public for not that long and only been scaling their operations roughly for the past 2 years. Adjusted net income loss is about 11%, which is not all of that bad right now, guys. You can see the revenue metrics here scaling very nicely. Adjusted operating income, the losses right now, the losses not too bad right here, but 16%, well, it's not a loss. It's actually a profit by about 16%, which is fairly good in terms of operating income. Not too bad. They're scaling. Once again, you have to remind yourselves, right? These companies don't always start off profitably, and that's what we're going to focus on. The loss is here, on the net income margins overall, but you can see it was a bit better than we previously had in Q1. So what you don't want to see is expansion of the net losses overall as the company is scaling. So the company has a bit of operating leverage right now. It's scaling revenues, but it's able to control costs as best as it can for the time being. Obviously, we don't have a very large sample size, but right now it's not looking too bad. EBITDA we went over as well. Again, revenue backlog, which is absolutely massive, guys. Absolutely massive. Now, some of this is short term in the next 2 years. A lot of it is 25 to 48 months out. And then your longer duration one is only 10%. So a lot of this revenue backlog is going to be coming online here within the next roughly 3 to 4 years. Now, in terms of CapEx remains a big number for the company because, of course, well, they are supply constrained right now. There's a lot of demand for their products, so they have to build out the infrastructure to be able to fulfill essentially all the demand that they have. 33 data centers already worldwide, some in Europe, but a lot of that in the United States. 470 megawatts of active power, contracted power. This is in the backlog. 2.2 gigawatts, which is absolutely massive, guys. Absolutely massive overall. So those are the numbers at a glance on CoreWeave. Not that bad. In terms of your forward guidance here, here's the forward guidance that we talked about in the article. Revenue coming in above the expectations, which is good on a Q3, but also a full year guidance estimate. Adjusted operating income, you can see here, adjusted operating income for the Q3 period is only going to be about, well, as we saw, right? It's not that large, low teens, but you can see here, it's getting better. I'll just do the calculation for you guys right now, right? So let's call it 175 at the midpoint right there, divided by your 1.28 billion essentially, so 1280. It's going to be about 13.6% operating income margins. If you take a look here for the full year guidance, they're getting a little bit better, 815 at the midpoint. We'll take we'll take 525, right? That's about 15 and a half. So operating income margins getting slightly better moving into the year end, which is the direction that you want to see the company go in essentially, right? Not too bad at all. CapEx though, if I move myself over, you'll see CapEx for the total end of the year is going to be $20 to $23 billion, but they do have the backlog to sustain a lot of this CapEx. So please keep that in mind when you're looking at CoreWeave. Now, some of the deals, I know this is very small here, but some of the deals that they do have here, guys, was obviously the scaling of the deal with OpenAI. $4 billion expansion deal on top of the previously announced $11.9 billion deal as well. So OpenAI is going to be a very big customer for them. I would not be surprised if they're able to get more and more customers as as they continue to scale operations as well. So very solid overall, guys. I like this. And in terms of the debt, so they did raise more debt, $2 billion more in unsecured notes. A lot of their debt pipeline, guys, is long dated, meaning 2028, 2029, and 2030. So it's not too bad. You can see in terms of their current cash right now, which they have, is about 1.15 billion, which is not that much cash on the balance sheet, I will admit, right? But in terms of current debt, 3.6 billion. It's not terrible. It's not terrible, right? The non-current liabilities are about 7.4 billion, but non-current is anything after about roughly the next 2-3 years worth of time, right? So they have a lot of time to refinance that debt. Overall, if you take a look at the debt numbers here, which is concerning to most investors out there, they look at this and they say, man, the company has $11 billion of debt currently. They're spending a lot of money on CapEx, and as a result, hemorrhaging free cash flow. This is indeed true. They have to scale with more debt to scale their operations, but they have a tremendous backlog. The company has okay operating margins, and eventually when they are scaled up, I truly do believe that they will be able to bring money to the net income bottom line to start repaying some of that debt down. Now, what is another company that operates in the cloud that spent a whole bunch of money scaling operations and that has a ridiculous amount of debt in relation to their market cap, right? CoreWeave's market cap right now, they got a lot of equity. So debt to equity profile is not terrible. You guys want to see a company that has a tremendous amount of debt? I'll show you one. You guys know this one very well. Oracle, right? And people don't seem to care right now because it's the AI narrative. Now, I'm not saying if that's a good thing or a bad thing. I'm just here to say, if you want to see a company with a tremendous amount of debt, look no further than Oracle. Oracle has $109 billion worth of debt for a $700 billion market cap. Do those numbers seem familiar? It's literally the same thing, right? It's literally almost the same thing, almost a 1 for 7. On Oracle, CoreWeave right now is arguably roughly the same. 72 billion market cap, 11 billion worth of debt. Arguably a 1 for 7 as well. So if Oracle is able to do it, I assume, this is my assumption, that the market is going to allow them to trade at these multiples as well in spite of that debt, which is why I say the debt argument may not be a good enough argument to forego investing in the company if this is a business model that you like. So we will have to also take a forward price to sales estimate because we do not really have net earnings, or the net earnings are going to be very choppy here over the next few years. You can see there's no EPS here for the next 2 years, roughly. This year in 2026, 2027 and 2028 will be EPS positive. Look at this revenue scale, guys. Massive. $5 billion this year. By 2028, $21 billion in revenue possibly going to be on the table. So as a result, right now, the company at 130 in terms of the forward price to sales for this year, they're trading at a 14. This is what the market is allowing them to trade at. It's been very volatile, right? But this is the overall range between roughly $180 and $100 to the downside. It's a very wide range, I agree, but it's not as if the company was never able to scale past, $30, $40, $50 per share. And it's also not as if the company got all the way up to $300 per share. I would say that now that this one has been online in the markets trading for a better part of the last, 3-4 months, average price to sales for this company right now at 13.96 for a fast growing tech company. That's not crazy, guys. I can show you a whole bunch of tech companies, especially in cybersecurity, that trade at much more rich valuations than this and also are not currently yet profitable. So this one is not too egregious in my humble opinion. If I take, however, a more normalized price to sales, a more standardized one for a well-established tech company, if I take a 10, I'm not even going to build a bull case for this one. I'll just keep a normal case, 10 price to sales for 2028 and use the 2028 sales forecast at 21.3 billion. In terms of sales, that gives them a $213 billion market cap, aka that gives them a forward target for a share price of roughly $393 per share. That is definitely not too bad from here by 2028. If it hits that at a 10 price to sales, they're able to scale, they get positive EPS, they're able to maintain operating margins, maybe improve them a little bit, maybe bring some of that money to the bottom line, and they're able to refinance their debt, such as Oracle's been doing and many other tech companies have been doing as part of their growth strategy, right? If they're able to grow that from here at 133, you're going to be looking at roughly a 2.95x Not that bad for the next 3 years, guys. That's a very strong compound annual growth rate. So risk-adjusted returns are quite good. There is some risk involved in this one, but the ROI, if indeed this is correct and the thesis proves to be correct, is decent, which is why I say the risk-adjusted returns are not so bad. I'm not saying there's no risk. I'm just saying maybe the returns for you might be worth it. If you ask me what I'm doing, I definitely will also be positioning with some CoreWeave shares. I wanted to see their earnings and their guidance before positioning. You might remember I've been playing the wheel on this one a ton of times over the course of the past 5-6 weeks as it's been declining. Tomorrow morning, first thing tomorrow morning, I'll be once again selling some puts, but I will also start adding some shares to a longer term swing trade for the next 2, 3, 4 years as this company scales and starts bringing on a lot of that capacity, right? So that's everything for our CoreWeave earnings. Hopefully you guys enjoyed that one too. Now let's move into some charts, shall we? Okay, so take a look at the SPY real quick. 1.06% to the upside. As you guys know very well by now, the bulls are in absolute full control, engulfing the entire non-farm payrolls drop right now, looking solid, recapturing the 12 EMA short-term momentum moving average, of course. In the event that we see a bit of a downswing, well, we're going to be looking for a higher low. Anything above 620, new higher low for possible further trend continuation. The bulls looking not too bad. There's nothing else to say, guys. We only get interested when we have a bit of a downswing, and then we're going to look for follow through by the bears. As of right now, they did not get it. The bulls completely engulfing. They resume full control. Very logical, though, because they never lost the weekly timeframes, guys. It's going to take a lot to derail this market. It's going to take consecutive months of bad macro to leave a bad taste in anybody's mouth right now and to unwind a lot of the institutional and retail positions that were built throughout the downswing here during the initial tariff sell-off. So keep in mind on the weekly, the new higher low is 619 as well. The bulls just looking for a little bit of further expansion, and possibly the next psychological target would be 650, round number on the SPY. On the QQQs right now, very solid day by the Qs, very solid day by big tech overall too. The higher low stays put right now at about 552, the low of the non-farm payrolls. Engulfing move, any move lower, I'll remind you, looking for a higher low. For possible further trend continuation, watch for tags of the 12 EMA. The bulls have been having a lot of fun riding this one for a better part of the last 3-4 months at this point. Next target for the Qs, well, you have to go with psychological round numbers, 590 and then 600. They're not going to do it in one day. Those are just the possible price targets. Any downswing, as I'll let you guys know, but the bulls right now remain in full control. And in terms of the weekly timeframes as well, decent move to the upside by the bulls right now. Your weekly higher lows are now set at the sell-off point of the non-farm payrolls. Great weekly leg of upswing underway by the bulls right now. A lot of space, right? And a lot of bullish activity in the markets. Moving into financials. Financials finally getting some lift. New daily uptrend. It was challenging for financials, but we were saying that this area, this resistance area, was proving to be good support for the bulls. They held it once again, held the weekly 12, and now might just be looking for a bit of an upswing here, trying to attack the highs at 53.50. Not bad. Some of my favorite names still in financials again remain Visa in around its 200-day EMA. Very strong. Berkshire making a little bit of a recovery today, but still a lot of work to do. You need to see them capture some of these daily EMAs, and especially the weekly ones as well. We're kind of trading below everything right now, but Berkshire has been out of favor. But not only Berkshire, guys, the entire insurance landscape, other than Allstate, which is currently at highs. I mean, if you look at other large insurance players, because Berkshire, at the end of the day, their main line of business is property and casualty insurance, right? Look at Chubb. Chubb also down. If you take a look at other names such as Brown Corporation down. Take a look at PGR also down. So the entire insurance landscape having a bit of a downswing, but Berkshire, very solid company, could be an opportunity, but it's not going to be a very fast mover. It's an accumulation of a position right now. On to healthcare sector. The healthcare sector coming back above the infamous 130 lows that we said they could not close below this with a weekly candle. They have not done it since the tariff sell-off, and they have not done it still. Not looking too bad, but a very wide and volatile range right here. The clearest time frame on healthcare for me remains the monthly time frame. Still trying to establish monthly lows. Not too bad in or around the monthly 50 EMA, which is an EMA that very rarely gets tested. And when it does, traditionally, it does represent a good buying opportunity. Similar to other things in this market, guys, healthcare right now is not a very fast mover. This is an accumulation trade, meaning you need to accumulate positions here at the lows slowly. And then eventually when the rally does come, it will probably come pretty quickly, but it's a very slow moving index. So as a result, I have call options, but my call options are for January 2027. onto SMH semiconductors right now, looking very strong today, 2.28% to the upside, brand new all-time high, looking very good. Daily uptrend reset by the bulls, and now recapturing the 12 EMA as well. So you guys know the drill. Any move lower from here, looking for a new higher low, anything above 283. New higher low for possible further trend continuation. We've made it above the slight area of consolidation, so a back test would probably be down there, something like a 295, 293 for a bit further of an upswing. In the event we get an engulfing move, I'll let you guys know what we're looking for, but right now, new all-time highs. It is currently the bulls' turn. The bears had a turn here for a couple weeks. Couldn't get it done. Weekly uptrend is very nice as well. The weekly higher lows established now are about 278 on the weekly time frame. Not looking too bad. Looking for a bit of expansion. Psychological targets 310, 320, and for the SOXX, also establishing somewhat of the same pattern. Not a new all-time high there, but looking pretty good. Daily uptrend as well. And just looking for the new weekly leg of expansion. Higher lows are now set 232. It's been a very nice weekly uptrend, and I was telling you guys, back tests of this area could be good for some new longs on your favorite trades. So maybe you guys are able to get some of the bottoms. I know not everything pulled back, but the two names that I was looking at the most were Micron during that correction and also ASML towards the lows down here. So hopefully you guys are able to get a bit of a piece of that pie. If you didn't, probably there's going to be some more opportunities in the near-term future. IWM Russell right now up almost 3%. Very strong. I told you guys, I've been saying this for a while, right? This one moves on rate cut sentiment. Nothing more, nothing less. It is the single biggest component that will move the Russell. Daily uptrend right now recaptured by the bulls and attacking resistance again, 231 down to 225. This one's been lagging behind the market a lot, guys, a lot. Take a look at what they've done since 2021. Absolutely nothing. They're still negative since the highs of 2021. Not too bad for an expansion play, but if I had to play the Russell, I would be playing it very, very small because the rate cut path and the details of that path are still somewhat unclear. Moving on to our VIX. So VIX is down 9% today, hitting some of the lows. So I was saying that today could give the opportunity for a volatility catalyst if CPI came in hotter than expected. But obviously now that the market's enjoying the data, the volatility, the concerns are kind of out of the way right now, less uncertainty than there was yesterday. And as a result, the VIX is the uncertainty metric, right? And uncertainty right now in the markets is quite low. Inflation numbers are not upticking in a violent way. The rate cuts are probably coming. The economy is not unwinding at a rapid pace. The jobs market is still good. Net new additions of new jobs, not so much, but I'll remind you, the JOLTS job openings show that there's still 7.5 million jobs in the economy, and we're still sitting at full employment, guys, 4.2% unemployment rate. So there's not that much uncertainty in the markets right now, and as a result, the VIX is going down. What that allows us to do is any names that are left behind at a low VIX, you should be looking out for leap call debit spreads or leap call options on some of your favorite names. I'm not saying to buy the names with a lot of volatility at their all-time highs and just shove call options like ones on NVIDIA, but maybe some of your favorite high conviction names that have just been lagging behind the overall market performance, of which there are very many to choose from. Here is year-to-date performance. There were many. Apple was there before last week, essentially. I was commenting on this one, but there's a lot of other ones that have been underperforming that don't have very high volatility. So in the event that you wanted to position for a little bit of a catch-up trade on some names across the board, maybe not the worst opportunity because leaps are a cheaper way to position than shares, and you do get a little bit more reward on that. But I'm not telling you guys to go all out on leaps. I'm just saying when the VIX is low, they're the types of opportunities you want to be looking at, right? In terms of the yields, well, yields doing absolutely nothing. Like I said, until we get the Fed's actual decision in September, yields are probably going to stay stuck here. The 10-year yield probably will not crack much below 4.2, and the 20-year yield will probably not crack much below 4.75, which has been this area that they've struggled with in the past, right? But once that rate cut path is established, you might finally start to see longer-term yields on a bit of a decline, and as a result, you may finally start to see an upswing in bonds. As a result, that is not happening right now, however. So these bond trades also need to be very long duration trades. If you're DCAing bonds, guys, you got to be very patient. I know I've been saying it for 2 months, but it's just the truth, right? They're waiting for Powell. Moving on to gold right now. So gold, right, like I was saying yesterday, if CPI was bad, the gold hedge would probably be back on. If CPI was good, you probably would find not a lot of buyers, as people would favor equities in or above gold, right? So that being said, still looking for a daily higher low for a possible trend expansion, but I'm not so sure whether or not gold has the actual catalyst to do it. It's been range bound for a better part of the last 2-3 months. Why? Well, you can start to understand, guys, that when uncertainty was removed from the markets, the complete gold momentum stopped, right? So we'd be just doing nothing. The bulls are still in control. This is still, technically speaking, a bull flag, but it's very hard to position right now because if you lose some key levels, especially these guys down here, 33, you start losing that and into a weekly downtrend, you're going into monthly consolidation on this asset. There's just no way around it type of thing. Very tough for me to buy gold up here at a monthly overbought RSI when we know that there's less uncertainty in the markets right now. So keep that in mind if you're looking to position on gold. Bitcoin having a very strong day, closing the Tuesday session up 1.19%. Ethereum even better. We're going to talk about that soon. Daily uptrend on Bitcoin looking pretty good. Any move lower, looking for a new higher low. Anything above 116.5, higher low. But then again, we also have all of this prior support. It was resistance. The bulls made quick work of that. So if you do pull back, I expect this zone to stand the test of time again, be a nice little fallback area for the bulls. A quick little retest of 117 could provide net new entries for some possible further longs. In terms of the weekly is looking great. Demand zone has been created right now. The higher lows have been established, and now we're just looking for possible continuation in Bitcoin for maybe the next few weeks. If the markets overall keep staying bullish, your upside targets remain 125 and 130 psychological. I'm still a big fan of owning Bitcoin in the long term, guys. In terms of short-term swing trades, it's a little bit tough. I like to sell some puts on Bitcoin whenever we have big red days. I like to sell some puts as low as I can do on BITX, the 2x leverage version of Bitcoin overall. But in terms of Bitcoin longs, I'm not building any further longs here. I mean, every month I add a little bit of Bitcoin to my portfolio as part of a long-standing DCA process that I've been doing for years and years and years. But I'm not starting a crazy large position right here. But right now, the bulls are definitely in control. Talking about Ethereum, another chart where the bulls are definitely in control. Look at the day they just put in. 8.62%. And it's all in relation to stable coins, guys. The entire narrative behind Ethereum right now has shifted from one where Ethereum used to be viewed as a network on which you had several layer 2 applications, layer 3 applications, a lot of meme coin trading, and a lot of people just didn't see the purpose of Ethereum. But now institutions have been sold on the stable coin narrative. It's a very strong narrative because it's actually happening right now. Institutions are improving the back end of the financial system essentially via stable coins. And as a result, all the stable coins are currently using Ethereum as their main network that they're built upon, right? So that being said, this is what institutional volume looks like. This is just a whole bunch of retail, right? All of that, the retail hype back here, institutions weren't seeing it. Then you get the Genius Act and a couple more things. All of this is institutional volume, right? Big institutional volume. So that being said, Ethereum is looking great right now. Beautiful daily upswing right now. I mean, the next target right now is obviously the 5,000 mark on Ethereum, of course. If you get a pullback, just looking for a higher low, anything right now above, let's just call it 35, looking for a daily higher low and a nice fallback area in the event that for some rich reason we get consolidation before expansion. Well, clear area of support back here remains about 4,000 down to about 3,700. Not too bad at all. I'm not adding any Ethereum up here, but the consensus on the street right now is for $10,000 Ethereum at some point throughout the cycle, which could be synonymous with maybe the next 12 to 18 months type of thing. I don't know if it's going to do it that fast, but Ethereum has some very good legs in this trade right now. It's a bit tough to position right now. If you had to position, I would take a DCA approach into Ethereum right now, not buying everything at one level and just playing the pullbacks and try to build a position if you can. Moving into our big tech names right now. Okay, so talking about Apple first, Apple up 1.09%, very decent day for this company. Still struggling a little bit with the top end of resistance, which ends at 232, but the bulls are looking very strong. Any pullback, you guys know the drill, just looking for a higher low. Anything above 2150, higher low for possible further trend continuation. If Apple pulls back, we're going to be looking to retest down here around the 214, 215. All the EMAs on the daily are sitting right there. The weekly bulls are in full control of this chart, and with the way this weekly candle closed, and the CPI bullishness surrounding the market right now, I would not be surprised if this week is actually the breakout week for Apple. If you do get the breakout, next targets, of course, are going to be 240, and then you might just be looking for the breakout retest. So one of two trades is available, either the breakout retest trade, at which point in time I'll let you guys know. If we get the back test down here, a very nice area to be reloading some longs and also selling some short puts. Apple with a very phenomenal move, and I'm really looking forward to the rollout of the iPhone 17 and other new products that Apple has for us into the rest of the fall. Into AMD right now, AMD up 1.55%. Big swing today on AMD as well. This morning, this company was down another like 1.5%. Again, I sold some puts down here at 160, and I was out in the very same day with a lot of profit. So looking not too bad there. Just consolidation at your range highs right now. Resistance stays put 185 down to about 171. But look at the bulls. They're just coiling up here, staying very close to resistance, looking like they want to break it. If we don't, and we unwind and break below 157, you guys know the drill. Perpetual daily downtrend, well, not perpetual, but continuation of the daily downtrend, I should say. And at that point, we're going to be looking a bit lower down here to the level 151 area for the backtest of support. In the event that AMD cracks through the highs, we'll be looking again, kind of like on Apple, right? The breakout retest trade. As of right now, no swing trades on AMD for me just yet. I'm just holding the shares that I was able to acquire during this massive dip right there. But this one's still not a bad position for an add in terms of long-term shares overall, guys. The company's valuation at 170 is not too bad. I mean, I guess I'll just readjust this because we're not going to fall to 150 right away. So let me just redo this for you guys right now. None of the numbers just changed. None of the numbers changed just yet, only the price. So 170 by 3.87, you're looking at a 44 forward price to earnings for next year, or the end of this year. And then in terms of your PEG ratio, you are looking at about a 1.46 PEG, still a very manageable valuation. So in the event that you do not have a AMD position, that you want to go for expansion of the company over the next few years, my price target for AMD, if we're just to take a streamline price to earnings and a PEG and a price to sales, just streamline everything, right? Not even that much expansion. Considering the fact that they're going to literally 2x their sales by 2028, I would not be surprised if everything else stays the same. My price target for AMD in 2027, whether the midpoint of the year, end of the year, is about $300. So compound annual growth rate on this one is still quite good. It's a little bit challenging right now. Leap debit spreads, not a bad opportunity as well, but you'd have to buy one here and then buy the pullback in the event that does happen. But 2027 expiry on those leap calls, guys, not like February next year, right? Moving on to Amazon right now. Amazon, well, slightly flat on the day, but still not a terrible day for Amazon, just not doing a whole lot of anything. 228 down to 218 is the resistance range. We know it's a battle between the bulls and the bears. The retracement size by the bulls after the earnings flush is about 50%. So it's half-half, right? 50% odds that the bears are able to capitalize on this push and flush the lows, and 50% odds for the bulls that you're able to recapture. Obviously, if the market has a bullish leaning bias into the rest of the week, well, the bull thesis is probably going to be a lot more prevalent for this one. So we'll be looking for them to attack the gap fill location for Amazon right now. And in the event we come to the downside, you guys know exactly what I'm going to be doing. I will be gladly selling some put options down here. 210, I still enjoy Amazon's valuation. 220, 210, decent area to be adding to the position in terms of some long-term shares. I have some leap options that I bought all the way down here, and I'm keeping them, guys, pretty much all throughout 2026. Not a bet. Amazon is very high conviction for me, right? So I don't mind buying leap call options right here. My profit target for Amazon in the next year and a half is somewhere close to the $300 range. So there is a lot of money to be made here, but it might just be a bumpy path. So if I'm buying new leaps, there would be some here and some there. I know it's an expensive trade, but you can also use some call debit spreads, right? Moving on to Google right now. Google up a 1.25%, getting very close to Google's all-time high. 208 to be precise is the all-time high range. All right, we're currently cracking into resistance right now, 208, all-time high down to about 202. The bulls are looking very strong. The higher lows are set, 188. Beautiful engulfing move. In the event we get rejected right here, you'll be looking for a new higher low. Where could they establish it? Prior resistance, 12 EMA. They've been riding the 12 EMA for about the last 2 months or something like that. Wouldn't be surprised if this is a likely fallback area for some possible longs. If we do take that fallback a little bit, I'll be looking to sell some options down here into the 190 range using short puts, of course. And as you guys well know, the weekly bulls are in full control of this chart. Nothing to see here. Any pullback looking for a higher low, anything above 164. New higher low on the weekly for possible trend continuation. So this is the reload area for me on Google. But if I'm literally looking to buy some shares for a long-term portfolio, even at 190, 200, guys, the valuation is really not that commanding at all. My price target for Google into 2027 is probably about 260, 280 into 2027. So next year should be a good year for Google. We might get some volatility surrounding the the judge ruling that's going to come out in the fall, but keep in mind, they're probably going to appeal that ruling and it's going to be tied up in the courts probably for another year or something like that. On to Meta. Meta was the biggest winner of the day, very strong, and I was commenting on the fact that there's a bit of a swing trade opportunity here on Meta. I know a few people in my Discord were able to take this one, but maybe some of you guys on the YouTube channel as well. Consolidation after the earnings pump, stop loss was below there, your entry would have been in this consolidation range, and you are targeting the expansion. $800 psychological is going to be the first take profit, and then obviously you just let it ride and put the stop loss in around your break even type of thing if you're riding some shares, and just play with the psychological levels, right? 800, 825, 850 type of thing. So Meta's looking very good, breaking out right now. In terms of overall, your uptrend, so looking very strong. The bulls in full control of this chart right here, looking pretty good. And in terms of the weekly as well, not looking too bad. Your weekly higher lows are down there at 695. Beautiful, beautiful weekly uptrend continuation by your bulls. In the event you get any extended pullback and it breaches through the stop loss level for the short-term trade, you might just be coming right down here to this yellow line, which is pretty much the top end of consolidation. Prior all-time highs, that's going to be 733, 720, in line with this 12 EMA on the weekly that's curling up. Very solid, guys. I mean, the last time I added some Meta shares was a tiny little bit of an ad, prior to their earnings, but now that they had earnings, very strong. It's not that bad of a position up here. Decent compound annual growth rate still. I wouldn't be surprised if Meta over the next 2 years is able to reach that $1,000 ever so elusive mark. On to Microsoft right now. Microsoft, 1.43% to the upside. They didn't do it, guys. Daily downtrend, but I was telling you guys, watch out for the flush of the 12. They didn't get it. They only pulled back, almost filling entirely the earnings gap. Now the bulls are looking for a bit more, riding the heck out of this 12 EMA. So keep in mind, we are still in a daily downtrend. You would need to either see an engulfing move, right? Engulfing and recovery, or just possibly recover from here, not quite get the engulfing, but a two-step recovery process. Microsoft is not looking too bad overall. Very tough for me to position up here, though. It is very extended from the 12 EMA, very extended on the weekly RSI as well, but the bulls are still in absolute full control. Anything above 355, it is very tough to position on a chart like this. Microsoft for me right now is a hold. It's not a buy because the valuation is pretty stretched right now. Definitely not a sell, especially if I'm holding this one for the next 5, 10, 15 years. It's just a hold for me. Moving on to Netflix right now. Netflix up 0.57%. Netflix starting to come back a little bit, right? So this was the Microsoft trade I was telling you guys about, yeah? 12 EMA, daily downtrend flush. Daily downtrend right now. They broke below resistance. That was it for the bears, and now we get the engulfing move. So very strong engulfing move. Any move lower at this point, we're going to be looking for a reset of the daily uptrend. Anything above 1146, trying to go for the higher low, for possible further, or rather a new daily uptrend creation by the bulls. Not looking too bad, recapturing some of these short-term daily moving averages, which we lost back here in the month of July. And if we are able to recapture the daily uptrend, that will officially be your new weekly low. And I'll remind you, we had also lost the weekly uptrend, so they have to get that back too. Now, Netflix is a bit of a tough one in terms of a swing trade. There is a possible swing trade here on a bit of a downswing. Stop loss would go down below there, and then you would be targeting weekly highs up here. So the risk reward is not too bad on a short-term swing trade for Netflix. In terms of adding to long-term shares, in around 1250, the valuation is somewhat stretched. I'm not going to lie, somewhat stretched. The last time I bought Netflix shares was down here, slightly around 1200 or slightly below. It was a nibble for me. A little bit of a nibble, not a full size position, just a nibble DCA for a company that I'm looking to hold for the next 5, 10 years. Management's guidance, I'll remind you, for 2030 is that this could possibly be a $1 trillion market cap company. So the compound annual growth rate for the next 5 years, if we're looking for a double, roughly, should be about 20% per year. Not bad. That is roughly index beating returns even from here, right? Moving on to NVIDIA right now. NVIDIA up about 0.6%. So NVIDIA chart, very volatile, big downswings in the morning, then the bulls buying the dip throughout the day. But if you take a look at the daily, guys, who is in control of this chart? Clearly the bulls, right? The higher lows is down here at 171. In the event we get a pullback, just looking to set a new higher low for possible further trend continuation. We've just been grinding this 12 EMA. That's why I love the 12 EMA so much, right? It's the short-term momentum guide. If you lose it, and you lose the uptrend, well, that's when you know you're heading into a bit more weekly consolidation. As of right now, that is not happening. So rather than trying to perpetually short NVIDIA, right, or saying it can't possibly go higher, let the bears show you when they are ready to take over and when it's going to be their turn, exactly how they did that on Netflix too. So you can use the Netflix chart just as a prime example of what you're looking for when something loses momentum and looking for weekly consolidation. In the event that that does happen, you guys know exactly where we're going. Probably down to the weekly 12 EMA, which currently sits at around 160, right? 160, 165 is probably going to be that slight zone where we can get a bit of a retracement. It is also this guy right there. Moving on to Tesla right now. Tesla 0.53% to the upside. It's struggling a little bit with its resistance range, 360 down to 340. There was a very nice swing trade opportunity. Many of you guys in the Discord, I know you took this one when we were down here. Very nice expansion trade. We are now into the take profit zone for any short-term swing trades. So keep that in mind. We had a bit of a consolidation area, otherwise known as a bull flag. Not looking too bad. And now we have broken above said bull flag. In the event that you come back and back test the downtrending part of the upper end of this channel right here, might be a re-entry around the mid 325 range, 330 range. Test the weekly moving averages, because you know the bulls might just be looking to set a weekly uptrend and maybe go for this expansion beyond the resistance range. Tesla's not looking too bad. They're very tough for me to enter right here into resistance, though. I would need a back test for a new entry, or I just need a breakout. Give me a breakout and a retest, and I can play that one too. This one right here, you're kind of just buying and crossing your fingers, just hoping that the rest of the market carries it through resistance, which is possible, right? But it's just not a way to build good trading habits. Moving on to Palantir right now. Palantir, another 2.35% to the upside. 1 day's worth of consolidation and a brand new all-time high. The bulls are in full control right now. You know, we haven't really closed above, so even if we do get more downswings on Palantir, you're just looking for a higher low, anything above 151. New higher low for possible further trend continuation. Watch the 12 EMA, your short-term momentum guide again. And the weekly bulls, of course, are in absolute full control of this chart right here, looking very strong. Any pullback, you guys know the drill, looking for a weekly higher low. It is overvalued on everything you could possibly imagine. The weekly is overbought. The daily time frame also is overbought. The valuation is relatively crazy as well. Palantir for me right now, guys, quite simply, is just a hold. It's not a buy for me up here, at least. It's not a sell, right? Because we know they're doing good things. You know, it's a trim, yes, but not a full sell, in my humble opinion. But you have to realize, right, now the long-term thesis kicks in, because compound annual growth rate, if you're just keeping in mind their revenue expansion and their sales expansion for the next 2-3 years, the valuation still won't make sense, right? But if you plan to hold this company over the next 5-10 years, and you think they're going to be an integral part of AI as we know it today, and an integral part of company efficiency, this is, I mean, they're the only type of company with this business model currently offered on the entire market. That's why they trade at a premium right now. So if you're going for the longer term expansion of their market cap, that's fine, right? But in terms of short-term growth expectations, well, we're obviously not going to be expecting a double or a triple in the same amount of time that we've done since April. That would just be somewhat, not very logical in my opinion. Moving on to SOFI right now. SOFI up 5.5%, looking good. We were commenting on the fact that the bulls were holding very close to our resistance range. They struggled with it, but they stayed very close. Resistance range 2450 down to 2250, which is your prior highs from 2021. Not looking too bad there on SOFI. Everything is looking pretty good. They held the 12 EMA. You can see intraday, we tried to break below it quite a number of times, but closes below? No, right? So we have been riding this 12 EMA in a very nice fashion. The bulls are now looking for the daily uptrend expansion, looking to breach resistance. The daily MACD is curling over. There was a bit of a swing trade attempt. We were talking about it on the channel back here, right? Bit of a swing trade attempt for some expansion. Stop goes below the low, and you're looking for the expansion beyond the range. It's a very tight trade, right? It's somewhat counterintuitive because you're taking it into resistance, but the bulls reacting nicely here, not giving back too much at all. Looking for the next leg weekly higher, which is looking very strong for the bulls right now. Next target, of course, is going to be around number 25 upon a breach of resistance. And right now at $23, is SOFI still a decent buy? It's actually not that bad in terms of PEG ratio and in terms of price to sales. We did it at 21. It's marginally higher right now at 23.5. I believe this one should be best viewed in terms of market cap expansion. If you're holding this one for the next, let's say, 3 to 5 years, I do believe that SOFI is able to hit those $40-50 billion market caps, especially if they keep executing on their business models, keep onboarding clients. I don't think that's too far-fetched for the company. Moving on to Uber right now. Uber up 1.27%, still a struggle with the resistance range. 93 down to 90. Very choppy price action from the earnings, guys. Extremely choppy. One thing's for sure, though. In the event that Uber pulls back a little bit, I will gladly sell some put options down here into the 84 range. No swing trade for me, guys. It's a little bit too choppy. If you want a swing trade, I'd have to get a breakout and retest, because then I would have a clear stop loss area. And if we get a retest down here, 92, with a stop loss down there at 89, well, then I could target some expansion, maybe to $100 psychological. As of right now, price action is a bit too choppy for me for a swing trade. However, for a longer term buy at 89 bucks, we did it after earnings, the valuation is not actually so bad at all. So it's an ad for me. It's a nibble, right? Right now, I added most of my shares, not going to lie, through this entire consolidation period last year and into early this year. So I'm full, but if I had an Uber position that I was looking to build and seeing it close to the all-time highs, if that were to give me any hesitation, I would revert to my long-term fundamental analysis, and that would indeed tell me that, yeah, Uber is not actually that bad of a deal right now at a 1.17 peg and a 4.2% free cash flow yield. Moving on to TSM, TSM up 0.91%, still no new highs on TSM, but building some momentum. Kind of looks like Meta a little bit, right? Whereby, Meta after earnings, right? Very choppy, but the bulls holding very close to the all-time highs right now. We've reclaimed the 12 EMA. We're looking to build a bit of a new daily uptrend at this level. We'll see if they get it. In the event that we don't, well, we're just heading into more consolidation. This is sideways consolidation. You could call it a very wide and ugly bull flag on the weekly timeframes, and I might just agree with that. One thing's for sure, though, if you get a downswing on TSM, which would be surprising, but if you do get it, you're going to come all the way down here to 227, which is the 12 EMA, and that would open up some short puts all day down here into the lower $220 level. In terms of a long-term position for TSM, this is indeed an ad for me right now. The valuation is still very, very manageable at 245. The free cash flow yield is not the best right now because the market cap is so high, but in terms of forward price to earnings and a PEG ratio, the valuation is very manageable. I think TSM has a lot of good years still ahead of it in terms of this business. That is everything for your big tech rundown, your market rundown, and everything in between, and your earnings. Now let's do a couple minutes here on the biggest gainers and losers of the day. So let's start off with some of the biggest losers of the day, as a matter of fact, because there weren't that many. We're going to talk about Duolingo right now. So Duolingo, sadly, unwinding everything after their earnings and even more. Is this company a buy right now? Yes, but it's a slow accumulation buy. We know that the OpenAI narrative and translation services narrative hit this one very hard, right? A lot of talk about LLMs disrupting this company's business model. We kind of dispelled that thesis, or rather disproved that thesis when we covered their earnings when I did the video last Saturday. Make sure you check that out if you haven't so far. I just today started a little position in Duolingo, which I will be adding to in the event we fall to the 300 down to 270 range. The valuation right now at 320 is a bit more manageable, especially in terms of the PEG, only a 2.4. Company's growing revenue and EPS at a very fast clip. Price to sales is still a bit on the higher end here. They are expanding sales at a very fast pace, but you always want to make sure that you're getting the best possible price for this one. So I've been patient enough, waited for them to unwind this earnings move. We are somewhat short-term, extremely short-term oversold, the 1 hour, but you can see here on the 4 hour, not quite oversold because of that earnings move, right? If I were to remove the extended trading hours, same. You're not really oversold because of the big gap up open after earnings, and daily, still not. But if we end up in a situation, guys, where we slide and go into oversold conditions, I will be building a bit of a Duolingo position into these lower levels where the valuation is a bit more manageable, right? And where the trade makes a bit more sense. In terms of short-term trades right now, since we do not have any of the short-term timeframes being bullish, it's very tough for me to just buy here with some call options and claim it's the bottom. No, for that, you need the new daily uptrend. When you wait for the daily uptrend, technically, a lot of the times, good things do happen. Look, watch, wait for the daily uptrend and you get some follow through, right? It serves no purpose trying to pick the bottoms and perpetually be wrong. Wait for the bulls to show you where the bottom is, wait for the confirmation with a stop loss, then you can enter for some short-term swing trades. For me, for now, just building a little bit of a shares position. I know it's boring, but it also works. Into Oscar Health right now. Oscar for me is a short put opportunity down here. We've been talking about it a lot the last few weeks. 14 down to about 12 bucks. Fastest horse in the race in terms of the healthcare insurance plays. And I do enjoy this overall support area that's been built by the bulls over the course of the past roughly year and a half. So I will be farming the heck out of some short puts down there. And even leaps, guys. I mean, leaps are like a lottery play on this one. You'd have to go like 2027, January, and you just go for it, right? You go for the out of money $20 leaps. Bet small, because it's not a sure bet, but if the health insurance sector recovers at any point in time, I think this is the fastest horse in the race. It's easier for this company to go up in market cap by 50-60%, meaning 50-60% share price appreciation, than it is for UNH, right, at $240 billion to add that same 50, 60, 70%. That's why I'm going with Oscar Health overall. Moving on to HIMS. HIMS as well for me is a short put play. We've been talking about this one too, selling short puts in around the 200-day EMA, in around the Novo Nordisk news bottom is the preferred strategy that I will be going to moving forward. HIMS, you guys know I added some shares here. I sold half of the shares up here, and now I might just be looking to buy back if we make our way into the lower 40s. I'm not saying it's going there. I'm just saying if it goes there, that's where I'll be positioning. No short-term longs for me right now because the bears control the daily time frames. Wait for the daily uptrends. I always tell you guys this, right? If you just wait for the daily uptrends instead of trying to pick the bottoms, good things can possibly happen. Like, look, when you get the daily uptrends, finally, you get a lot of follow through. So wait for them to show you. Same thing here, right? You can set a stop loss when you get the daily uptrend. You enter here, the stop loss goes below there. You wait around for a little bit, and if the bulls truly want to take control, then you have a much higher success rate. So keep that in mind. Rocket Lab, unfortunately, down a little bit today, 3.53. Where this one becomes a short put play for me would be way down here. I know Rocket Lab shareholders don't want to hear that. This one has a lot of good volatility, though. It doesn't take that much. 1.56% day down into $40. You could probably find some short puts. You'd be surprised in the lower 30s. It remains a short put play for me because the company right now is very richly valued. Sorry, repositioning myself on my chair right now. And other notable companies that we want to look at in terms of the downside, not really. Those are really the ones that I want to bring your attention to. In terms of the upside, ETH, of course, the 2x leverage version of ETH. Now, if you want to play the volatility on this one, this is the area, right? If you look at Ethereum real quick, okay, so this right there is 3,500. If we're looking for a test of roughly 40 to 39, if you want to play this back test of this area right there, and you want to use ETH as a proxy, not financial advice, because it's, you know, you guys know the nature of 2x leverage ETFs sometimes. You'd be looking to sell puts down here, 124, but it's very, very expensive. You can use ETH. If you just want to use normal shares, right? ETH would be a back test down here of 32. Selling some puts in that area would get you a position in Ethereum, so keep that in mind. The airlines soaring today, well, because of the airfare travel price increases as measured by the CPI, 4.4% year over year. A lot of the travel companies, you know, moving a lot off of that. Also some news that maybe Spirit Airlines may be looking to sell the company to the highest bidder, I assume. So a lot of companies may be repricing to get some of that market share. I don't really play the airlines, been very clear about that. Moving on to Restoration Hardware. This, guys, is like the X Factor play. It is literally the X Factor play. The valuation is not so commanding. Yes, it's high-end furniture. It's a boring play, but this is a play on interest rates. Similar to mortgage companies, similar to consumer discretionary, anything that requires financing, right? This is not a bad play. This is a play in which you bet small, and you might just be surprised, right? It does not take Restoration Hardware too much to go up 50%, 60%. They were literally just there in the month of February overall. The valuation, although I haven't redone it at 237, you can see I did do it at 150. It was quite manageable. If I just had to extrapolate, right, you're like a mid-teens forward price to earnings, and you're barely a one peg. And the price of sales is also pretty decent right now. It's a $4 billion company, and that's right around how much revenue that they're going to be doing in the next couple, quarters. For the total of the year, right? 3.52, next year 3.87, the year after that 4.21. Not a very commanding valuation, which is why I say it's an X Factor trade, right? So a little bit of shares, not too bad in my humble opinion. If we take a look at anything else, I mean, not really. Oklo had a tremendous day of upside. I'm more of a fan of playing maybe SMR on these pullbacks, selling some put options down here at 32. But Oklo, I mean, there's no trade on Oklo for me right now, sadly. I'm just using this one as a proxy. It's very tough to go chasing Oklo all the way up here. Tempest AI, very strong move. We were commenting on the fact that after earnings, it was decent to sell some puts right there. Tempest AI is the same thing as a lot of other quote-unquote lottery trades in this. This is a very good company, okay? Very solid company. A lot of institutional interest in this one. Was made famous by Nancy Pelosi's husband buying a whole bunch of call options, and that's fine, right? But if you do play this one, you got to play it small. Not opposed to doing some 2027 call options, but like I said, only risk what you are willing to lose because these bets at the end of the day are somewhat more on the speculative side, but the company is growing well. Can't take that away from them. NBIS running after the CoreWeave news from its own earnings and from CoreWeave running up as well because NBIS is somewhat tied to CoreWeave. Very tough for me to position up here though. Any pullbacks, maybe I'll let you guys know, but very tough for me to chase NBIS into some crucial areas of resistance which are coming up shortly. Open Door, maybe it might be making a little bit of a resurgence, this one as well. Bet small. If you're going for the squeeze and going for the Carvana trade, you got to bet small, guys. It's all about betting small for these plays that are not some of our core positions overall, so keep that in mind. Rocket Mortgage, phenomenal day for Rocket Mortgage. I have some leap call options that we built all the way down there in like the $12 area. In the event that you somehow get an unwind and a pullback down into the 16, 14, this is where I'd be looking to build more of a position in Rocket Mortgage overall. Right now, it's kind of gone. I mean, it's not as if I didn't give you guys a fair amount of time to do this, right? We were talking about it for like the last 2 months, saying it was like my favorite trade for playing interest rate sensitives and consumer discretionary anything that requires financing. RKT, obviously they have, acquired Redfin recently, building their online presence. They're acquiring this company as well, Mr. Coop Mortgages, which is a very strong mortgage company. Rocket Mortgage, man, heck of a player in the online mortgage space right now. And even some of the home builder plays, BLDR, materials play, but XHB. Keep an eye on this one, guys. Keep a very close eye on this one. After 9 months of being down, we're finally starting to see an upswing. It's very early, right? If your thesis is that Trump is possibly going to do something for the mortgage market, which he's been talking about in the past 2 weeks, and if interest rates are going to come down, the housing market right now is deathly slow, right? It's very slow right now. The housing market is like watching paint dry right now, but the home builders are starting to run ahead of that narrative switch. So still a lot of juice left in this trade for some possible expansion. My favorite way to play this one is slightly in the money leap call options. They're very cheap and you can get a lot of time on them as well. In terms of CoreWeave, we already went over it. This one's a buy. And in terms of the other things, guys, I mean, there's a lot of other names that we covered on a regular basis. Affirm is probably one of my favorite bets as well. Consumer financing anything for 2026 and 2027. This is another one of my favorite thematic plays. I think it still has some good momentum, building a bit of a share position here and DCAing as we drop back into the 65s. Not a bad area, but it's going to be a very volatile trade, and you have to have that long-term thesis. If you do not have that thesis, guys, it's not going to be a good trade for you, right? Fortinet also, we covered it after earnings. Not a bad buy for shares and whatnot. Swing trade longs are a bit tough because we're coming into resistance. But if you get a pullback here a little bit, stop loss, as I said, goes below there, and you're looking for the daily trend change attempt. You're not too sure if you're going to get it. Still oversold conditions right now. Not bad for some shares as well. And Elf Beauty, another one we talked about, right? Down here was a great buy after earnings. Looking good. The bulls still need to switch this around in terms of an uptrend, right? Still need to go for the lower high, or the higher low, into higher high. If you get a back test down here, I'll be looking to sell puts again on this fantastic company. And Palo Alto Networks, we were talking about this one as well. They have earnings coming up in terms of next week, so a bit tough to position prior to earnings. I think they'll do well, but this is still an area where I do not mind selling some puts under the market. Fantastic area of support for the company overall. And I think that's pretty much everything that I wanted to cover, guys. Obviously, the entire market is up, so it's tough for me to go through everything. But still, as more plays come into this list right here, I'll try to tackle the most of them as humanly possible. But that's it for today's video, guys. Hopefully you guys enjoyed today's video. It was a long one, I know, some of our last earnings, but I had to spend more than 7 minutes on Circle and CoreWeave because you have to do the assumptions, you have to explain the business model. They're brand new companies, so a lot of people just don't know what they're looking at. So I spent a bit more time. It's not as easy as doing earnings on like Apple or Google or stuff like that. So hopefully you guys enjoyed today's video, even though it was a bit longer. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing as well. We do these every Monday to Friday after the close. And last but not least, if you have any questions, please feel free to ask them down below, and I will be very happy to answer you. I always enjoy reading your guys' comments. And last but not least, if you are interested in joining a trading and investing community of members such as yourself who are looking to grow their long-term portfolios, but also trade the markets too, and have a consistent approach to both, you may consider joining our trading community. In that trading community, investing community as well, you get access to all my personal trades, whether it's the wheel trades, the directional bets with call debit spreads, shares, leap call options, and everything in between. You get access to all those. Here's just a lot of the trades that we've been making every single week. I always do a recap for all my members throughout the week. So these are just a lot of the trades in the past couple of months, right? The green check marks are little wins. The red little circles are little losses. So you get access to all of those. You get access to our private morning live streams too. Every Monday to Friday for about 2-3 hours at the open, I trade live and then take all your questions on your stocks, your options, your long-term portfolios. If you're not there, they're recorded. Of course, you can ask me all your questions in our chat rooms throughout the day. Very fast to answer, you guys. You guys also get access to our private video section where I show a lot of knowledge on technical analysis, fundamental analysis, and other trading strategies that I use for my own portfolio. A lot of advanced option strategies in there that I don't show so much on YouTube, and how to grow portfolios, small, medium, large portfolios. What portion of your portfolios should be in which strategy? That's a common theme that a lot of people struggle with, and a lot of other educational videos as well that our members find very good value in. And last but not least, you get to copy all my charts, copy all my watch lists, copy all my charts. If you struggle with drawing support resistance levels, you can just steal mine and steal my charts. And it also comes with all the earnings recaps that I do on hundreds of companies throughout the year. Of course, you could just copy paste all of this. It's just an added bonus to our Discord members. If any of that interests you and you want to participate in our community, the link to join is down below. Hopefully I get to see you guys in there soon. And if not, I'll see you right here on the channel again. Take care, guys. Have a good day in the markets tomorrow. That's it for me. Peace.